Now that you know a little bit about how income taxes are computed, let's look at some sample problems like you'll see on the test. We'll start out simple and then add some layers of complexity as we go along. So by the end of this video, you should be pretty comfortable with the basic elements of computing income tax liability. And the questions that you see on the test about income taxes should be pretty simple. Before we get into the problems, though, let's review some basic tax terms as we did in the last video. First, gross income. Gross income, your gross income represents income from all sources. This is your earned income. Now, this is the term that the government uses to refer to the income you earned through your labor. Salary, wages, commission, other income you earn by working. Unearned income is investment income. Capital gains, interest, dividends, whatever it is, income you didn't have to earn by working, but you earn through your ownership of assets or by some other financial investment. And then it also includes everything else: gifts, inheritance, gambling winnings, prize money, whatever it is. Gross income represents income from all sources. Now, from gross income, you would subtract exclusions in order to get gross taxable income. Exclusions include inheritance, profits from the sale of a home, life insurance benefits, child support payments that you received. All of these are exclusions, and you would subtract those from gross income to get your gross taxable income. Now, from your gross taxable income, you can subtract the following adjustments. The adjustments include your contributions to your traditional retirement accounts. That would be the traditional IRA and the traditional 401k. Also, interest payments on student loans. These are also adjustments. And there are some others that apply. We don't really need to go over all of them here because this isn't about actually computing somebody's taxes. This is about becoming familiar with the way in which income taxes are computed. So once we deduct adjustments from our gross taxable income, we get adjusted gross income, AGI, adjusted gross income. Now, from the adjusted gross income, we can subtract deductions. Deductions are expenses that the government deems necessary, and therefore you don't have to pay taxes on them. So you can deduct these expenses from your adjusted gross income to get taxable income. Now, the main deductions would be taxes that you paid during the year to state and local governments, like property taxes, interest that you paid on your mortgage, that is tax deductible. Some medical expenses are tax deductible. Charitable contributions are tax deductible. So once you list all of those expenses that count as tax deductions, once you itemize them, you list them, you can add them up and see what they are. Now, rather than use that added up list of itemized deductions, you may wish to use what the government calls the standard deduction. Now, the standard deduction applies to everyone. You can either choose to take the standard deduction or the sum of the itemized deductions. You can't take them both. You take whichever one is the larger of the two. Okay. So then once you subtract deductions from your adjusted gross income, you get taxable income. Now, taxable income is divided into two categories. That would be ordinary income and income subject to special rates. The ordinary income are subject to the marginal tax rates, which we described in the previous video. And the income subject to special rates are not subject to the marginal tax rates, but instead assigned some special rate. And that gives you then your tax liability, Then from the tax liability, you get to subtract tax credits. Tax credits are different from deductions. Deductions come from your gross adjusted income. Tax credits are subtracted from your tax liability. Sometimes they're called direct tax credits because they are subtracted directly from your tax liability. And this would include a child tax credit. You get tax credits, although not as large for a child, for other dependents whom you support. You get tax credits for other things like installing solar panels, buying an electric car, whatever it is. It changes from year to year. Okay, so for our purposes here, the income subject to special rates primarily include dividends and long-term capital gains. Long-term capital gains. Those are profits from the sale of an asset that you have owned for more than 1 year. Now, short-term capital gains, profits from the sale of an asset that you have owned for 1 year or less, they are subject to the marginal tax rates. They're considered ordinary income. Okay. So let's look at a hypothetical problem here. So first of all, we will start by looking at the various tax brackets. Here's a 15,000 tax bracket, and it's taxed at the marginal rate, the rate that applies to that specific tax bracket, at 5%. That's the marginal tax rate for that particular segment of income. This next $35,000 increment of income, from 15,000 to 50,000, that's a $35,000 increment of income. That $35,000 increment of income is taxed at a marginal rate of 10%. Here's a $50,000 increment of income that's taxed at 15%, $80,000 increment of income that's taxed at 20%. There's a $70,000 increment of income that's taxed at 25%, and everything that you earn that is taxable over $250,000 is going to be taxed at 30%. So let's look at our initial problem, problem number one. Now you can get to these problems by clicking on these tabs at the bottom of the spreadsheet. Problem number one. Assume that Bill's salary for the year was $350,000. I wish I was that Bill. Unfortunately, I'm a different Bill. His life is pretty simple, so he has no exclusions or adjustments. The standard deduction is $22,000, and his itemized deductions amount to $18,000. His taxable income, therefore, is $350,000 minus $22,000. Now, that $22,000, of course, is the standard deduction. He uses the standard deduction rather than the itemized deduction because it's more. He has no tax credits, no investment income, or any other income that is taxed at special rates. So let's look over here at this table on the right to see a breakdown of his income. So there's his salary, $350,000. That's his ordinary income. He has no other income. So his gross income from all sources, is $350,000. His life is simple, so he has no exclusions. So the exclusions are zero, meaning that his gross taxable income is $350,000. He has no adjustments. Adjustments are zero, meaning that his AGI, his adjusted gross income, is $350,000. He does have deductions, of course. Everybody can take the standard deduction, which in this case is $22,000. So his total taxable income is $328,000. Now let's look over here to the tax table and figure out what his tax liability is. Now here's that first $15,000 increment of income that's going to be taxed at 5%, which means he's going to owe $750 on that particular increment of income. Now the next increment of income, as you can see, from 15,000 to 50,000 right there, that's a $35,000 increment of income. So here's that $35,000. That's going to be that $35,000 is going to be taxed at 10%, meaning that he'll owe $3,500 on that increment of income. The next $50,000 increment of income is going to be taxed at 15%, which means he'll owe $7,500 on that increment of income. The next $80,000 increment of income is going to be taxed at 20%, which means that he's going to owe $16,000 on that particular segment of income. The next $70,000 is going to be taxed at 25%, meaning that he's going to owe $17,500 on that increment of income. Now he's only got $78,000 left to get to the total taxable income of $328,000. And that $78,000 is going to be taxed at 30%, meaning that he's going to owe $23,400 on that particular segment of income. So his total taxes owed, add up that column right there, and we get $68,650. Now, if you were to ask Bill what tax bracket he's in, he'd say, I'm in the 30% tax bracket, which means that the last dollar he earned during the taxable year, in this case 2022, the last dollar he earned was taxed at 30%. So he's in the 30% tax bracket. But of course, that doesn't mean his entire income is taxed at 30%. This segment was taxed at 5%, that segment was taxed at 10%, etc. He's in the 30% tax bracket because that was the tax rate that was imposed on his last dollar earned. That was his marginal tax rate. But now let's look at the average tax rate. The average tax rate for this guy is computed as the taxes owed divided by taxable income. The taxes owed was $68,650. The taxable income, $328,000. That amounts to 20.93%. So his marginal tax bracket is 30%. His average tax rate, 20.93%. So let's go to problem 2. And in problem 2, it's going to be very similar, but we're going to add some few layers of complexity here. Assume that Charles's salary, now we're doing a different guy. Assume that Charles's salary for the year was $350,000. So Charles was also making $350,000, but he also inherited $50,000. So, Charles is doing all right, but he paid $24,000 in child support. He contributed $6,000 to his 401k plan at work and $3,000 to his traditional IRA. Now, the standard deduction is $22,000 and his itemized deductions amounted to $18,000. He has no tax credits, no investment income, no other income that is taxed at a special rate. So let's look at the table at the right for a breakdown of his taxable income, and then we can see the table below for the computation of his tax liability. So here is his $350,000, which was his ordinary income. That's what he earned from his labor. Here's the $50,000 that he inherited. So the income from all sources, $400,000. Well, that $50,000 inheritance, that's an exclusion. So we subtract that exclusion, and that, by the way, was the only exclusion that he had. We subtract that exclusion from his gross income from all sources, to get his gross taxable income. Now, from the gross taxable income, we can subtract the adjustments in order to get his AGI, his adjusted gross income. And his other adjustments amounted to $9,000. That was the contribution to his two retirement accounts, the 401k at work and the IRA that he set up at his bank or with his stockbroker or whatever it was. So we subtract $9,000 from the $350,000 gross taxable income. We get an AGI of $341,000. From that, we can subtract our deductions. And once again, because the standard deduction exceeded the sum of his listed or itemized deductions, he'll use the standard deduction. So 341,000 minus 22,000, that's 319,000. 319,000 is his taxable income. So here are the tax brackets. He's going to owe 5% on that first 15,000, which is 750, 10% on the $35,000 bracket, which is 3,500, and blah, blah, blah. Now, once he pays 25% on that 70,000, he's only got 69,000 left to get to that 319 taxable income, and that 69,000 is going to be taxed at 30%, which of course, not of course, but which is 20,700. So his taxes owed are 65,950. So if we ask him, what's your margin, what tax bracket are you in? He'd say, I'm in the 30% tax bracket, because that is the rate at which his last dollar that he earned was taxed. But what is his average tax rate? In this case, his average tax rate is taxes owed, 65,950, divided by his taxable income, 319,000, which is 20.67%. So let's go on to problem number 3. Once again, problem number 3 will be just a little more complicated. But before we do, let's go back at this. Charles inherited $50,000, but he paid $24,000 in child support. Now, he paid $24,000. He didn't receive $24,000. Does that payment show up anywhere over here? No, not child support. Child support is not tax deductible. Now, what you're going to see when somebody gets paid tax support, you'll see how that's treated in either, I believe, problem 4. But the idea here is that he gets no tax deduction, no exclusion, no adjustment for child support. Let's go to problem number 3. Let's read the scenario here. Here's a different guy. Assume that Mike's salary, this is Mike, for the tax year was $350,000. I don't know why I have a hang up of $350,000. But anyway, assume that Mike's salary for the tax year was $350,000. Mike is unmarried. He and his ex-wife divorced 2 years ago. They had 2 children who live with Mike, and therefore Mike is filing as head of household. Now we're talking about a filing status. The 2 guys before, Bill and Charles, their filing status was single. Mike is single, but he is also has a couple of children. And so he is filing now as head of household. That is his filing status. Now, these marginal tax rates are going to be the same from income bracket to income bracket, but look how the span of income, the span of the bracket has changed. In the first income bracket, the first 2 problems where the individual was filing as single, the first increment of income was $15,000, but now that this guy is filing as head of household, the first income bracket is going to be $20,000, from 0 to 20,000. And in the first 2 problems where the guys were filing as single, their filing status was single, The span of the second increment of income was $35,000. Here it is $40,000. So this is how the IRS accounts for the different filing statuses. Or would that be filing stati? I don't know. But I think you get the idea. So because he has dependents, in this case children, he's filing as head of household. So he's going to be, his income tax brackets are going to be a little bit different. The marginal tax rates are going to be the same for each bracket, but the span of the bracket is going to be different. The IRS allows a $3,000 tax credit per child. Now, notice that we have a green asterisk here. Let's go down and see what the green asterisk says. The green asterisk says a tax credit is deducted from your tax liability, deducted directly from your tax liability. It doesn't reduce your taxable income, doesn't reduce your AGI, it reduces your tax liability. So let's go up here and finish this. He paid, Mike now paid $12,500 in mortgage interest. He maxed out his traditional IRA at $6,000. That's what the maximum contribution you could make to the traditional IRA for 2002, as well as his traditional 401k retirement plan at work, which was $20,500. In 2017, Mike purchased a 1965 Corvette for $21,000 and sold it in 2022, 5 years later, for $28,000. Now that's going to be a long-term capital gain, profit from the sale of an asset that he held for over a year. He paid $12,000 in property taxes, $9,000 in mortgage interest, donated $4,000 to a qualified charity. The standard deduction is $22,000. And oh yes, Mike's wife paid him $16,000 in child support. So here, Mike's wife is paying him the child support. He's the one responsible for taking care of the kids. So let's look over here at this table for a breakdown of his income. So first of all, let's list income from all sources. That's $350,000 of ordinary income, $7,000 in long-term capital gains, $16,000 in child support. So his income from all sources, $373,000. Child support is an exclusion, so he excludes that. He doesn't even have to report exclusions. So that's going to drop his gross taxable income down to $357,000. Now he's got some adjustments. He made those contributions to his IRA and 401k, a total of $26,500 worth of contributions. So he's going to deduct that from his gross taxable income to get his AGI, his adjusted gross income. Now, if we were to look over here at the problem, we would find that mortgage interest, his charitable contributions, and the taxes paid to state and local government amounted to $25,000. That was the sum of his itemized deductions. So we're going to use the itemized deductions in this case rather than the standard deduction, because the standard deduction was only $22,000. His itemized deduction is $25,000, so we will use the higher of the two amounts. So we will deduct $25,000 from the $330,500 adjusted gross income and get $305,500. Now, that is his taxable income. But that's not this income that's going to be subject to the marginal tax rates, because he's got $7,000 worth of income subject to special rates. So we're going to subtract income subject to special rates from his taxable income. We're going to get back to that later. But the income that is going to be subject to his marginal tax rates, in this case, $298,000. So let's go over here to this table and compute his tax liability. This first $20,000 increment of income is going to be taxed at 5%, which is $1,000. The next $40,000 is going to be taxed at 10%, which is $4,000, etc. So he doesn't even get to this 30% tax bracket. He is going to pay this $80,000 right there, and after the tax on that $80,000, and after that, let's look at these marginal tax rates here. So after that, you can see he's got a span of $100,000 to pay. 210 to 310, it's going to be taxed at 25%. So once he gets there, that 25% tax bracket is only going to consist of $88,500. And here is his $298,500 worth of income taxed at the marginal tax rates. So we sum up the tax that he owes on each of these increments of income, and we get $53,625. Now we tax the income subject to special rates. In our case, the special rate is going to be 20%. In real life, it's some sort of graduated scheme here. We're not going to mess with all of that. We're not actually interested in doing this guy's taxes. We're just interested in familiarizing ourselves with the way in which income taxes are computed. And so this amount right here, $7,000, is going to be taxed at this hypothetical, for simplicity purposes, rate of 20%, and that's going to be $1,400. And when we add all of that up, we see that his tax liability is going to be $55,025. But we're not done yet, because remember, he's got two kids, and he's going to get a tax credit for these two kids of $3,000 each. So that's a $6,000 tax credit, bringing the taxes that he owes to $49,025. Those tax credits are subtracted from his tax liability. You might ask him, Mike, what tax bracket are you in? He'd say, I'm in the 25% tax bracket because the last dollar of income that I received was taxed at 25%. Well, here it says next dollar, and that would be the case if it was this year, but he's already earned it last year. He can't earn any more money last year. So the last dollar that he earned was taxed at 25%, so that's his tax bracket. But what is his average tax rate? His average tax rate are taxes owed divided by taxable income. Taxes owed is $49,025. Taxable income, $305,500, and that is 16.05%. That is his average tax rate. Now, if I'm going too fast, keep in mind that you can come and visit these tables yourself by looking at the Excel spreadsheet, which I am using here in Module 4, entitled Computing Tax Liability. You can, of course, watch this video again as many times as you would like. So let's go on now to problem 4. Problem 4 is going to be a little more complicated still. So here is, let's read the problem. Pat and Lee are a married couple with 3 small children. Pat is a computer repairman earning $90,000 a year. Lee is a CEO for a small startup earning $260,000 a year. Now, the two are filing jointly. Now, notice that the first two guys, Bill and Charles, they were filing as single individuals. Mike, in the last example, he was filing as head of household. This married couple here is filing as married, filing jointly. Married, filing jointly. When you file married, filing jointly, you're filing a single return between the two of you that includes the income and deductions for both individuals. Now, it is also possible, under some rare circumstances, that you might find it advantageous if you are married to file married filing separately. But this couple is married filing jointly, and what you are going to see here, as it makes note in this little box right here, that the income tax brackets, once again, are going to change. The span of the income tax brackets are going to change. In the last example, well, in the first two examples, the first income tax bracket was from 0 to 15,000. In the last example, problem 3, the first income tax bracket was from 0 to 20,000. And in this number 4, because the couple are married filing jointly, the first income tax bracket is going to be 25,000, not 20. The second is going to be 50,000, etc. Now, the marginal tax rates stay the same, but it's the span of the tax brackets that differ. Okay. Let's read the rest of the problem here. Pat and Lee are a married couple with 3 small children. Pat is a computer repairman earning $90,000 a year. Lee is a CEO for a small startup earning $260,000 a year. Wouldn't you know it, their total income is $350,000. Okay, the two are filing jointly. Now, the couple paid $14,000 in mortgage interest during the tax year, $12,000 in property taxes during the tax year, and $6,000 in donations to a qualified charity. Lee earned $6,000 in day trading, which means buying and selling stocks over a short period of time, usually a day or 2 days or 3 days, whatever it is. So those would be short-term capital gains, taxed as ordinary income, subject to the marginal tax rates. On December 31st of 2022, they sold 1,000 shares of Acme Widget Corporation for $160 per share, which they had purchased in 2019, 3 years ago, for $120,000 a share. So they made a profit, and the profit was on an asset that they owned for more than a year. So that was a long-term capital gain. Now, while they held the stock paid them a dividend of $12,000 during the tax year. Of $12 per share during the tax year. They had 1,000 shares, so that would be $12,000, but it paid them $12 per share during the tax year. So that's a dividend, and that's also is going to be taxed at a special rate. Both Pat and Lee maxed out their contributions to their IRA accounts, which was $6,000 each, and their 401k accounts, which was $20,500 each. Now, the IRS taxes dividends and long-term capital gains at 20%. In reality, it's much more complicated than that, and allows a tax credit of $3,000 per child. The standard deduction is $22,000. So let's look at this table over here and see the breakdown of their income. Their income from all sources would be $350,000 in salary, combined salaries, $6,000 in short-term capital gains. That's where Lee was day trading. $12,000 in dividends that they held that they got during 2022, the taxable year, for the stock they owned in Acme Widget Corporation. $40,000 in long-term capital gains. That was their profit from the sale of the stock that they held for 3 years. So $350,000 ordinary income, $6,000 in short-term capital gains, $12,000 in dividends, $40,000 in long-term capital gains. So let's start subtracting out stuff from our gross income, which is income from all sources. First, exclusions. You'll notice that there were no exclusions, no inheritance or life insurance benefits or anything like that. Their adjustments, the total amount that they contributed to their traditional retirement accounts, that is their traditional IRA and their traditional 401k, was $53,000. So that's an adjustment. And so we'll take our gross taxable income, 408,000, and adjust that by subtracting the adjustments. And now we get $355,000 in adjusted gross income. Now, if we were to go back and add up their adjustments, the mortgage interest that they paid, the taxes that they paid to state and local governments, the charitable contributions that they made, we will find that that adds up to $32,000, which beats the heck out of $22,000. So they're going to use that as their deduction. They're going to itemize rather than use the standard deduction. So we subtract that 32,000 from the 355, and we get a taxable income of $323,000. Now, not all of that $323,000 is going to be subject to the marginal tax rates. $52,000 of it, the $12,000 in dividends and the $40,000 in long-term capital gains, are going to be taxed at a special rate. So we'll subtract that out. We'll get to that later. And that means that $271,000 are going to be subject to the marginal tax rate. So let's go over here to this table and see how their tax liability and the amount of taxes owed are computed. So once again, here are the tax brackets, and here are the marginal tax rates for each bracket. The first $25,000 that of taxable income that they earn, it's going to be taxed at 5%, which gives it $1,250. The second $50,000 is going to be taxed at 10%, $5,000, etc. So here is the income taxed at the marginal tax rates, 271. Now we're going to go and add, and by the way, when we add up the taxes owed, we see that on that $271,000, they're going to owe a total of $42,250. So now we compute the tax liability on their income subject to special rates, which was $52,000. The special rate in this case is going to be 20%. Once again, in reality, it's more complicated than that. So in this case, the tax liability on this special income is going to be $10,400. And so we add that up and we see that their total tax liability on their $323,000 of taxable income is going to be $52,650. So we're not done yet. We've got this tax credit here. 3 children get a tax credit of $3,000 each. That's $9,000. And so we subtract that $9,000 from the tax liability of $52,650 for taxes owed of $43,650. If you were to ask this couple, hey, what tax bracket are you in? They say, oh, we're in the 25% tax bracket. That's because the last dollar that they earned in 2022 was taxed at 25%. But what was their average income tax rate? Well, that's taxes owed, $43,650, by the taxable income, $323,000. That was their taxable income. This subject to marginal tax rate, that's subject to the special rate. Total taxable income, $323. So when you divide $43,650 by $323, you get 16.3%. That's their average tax rate. So check these out. See if you can do these problems without looking at the answers. If you have a problem, of course, you can look at the answers. You can rewatch this video, and you can also post questions and comments to the discussions board. So we will see you on the discussions board.